So let's move over to your high dividend value ETF. So that's the AAM S&P 500 High Dividend Value ETF SPDV. So how is that different than the one we just spoke about?
Yeah, so it goes back to, I think, two different schools of thought in terms of dividend investing, which I'm sure a lot of viewers are definitely familiar with. You have high dividends and then dividend growth. Dividend growth, you're looking for companies that are growing their dividends at a fast pace or over, like I mentioned, a specific time frame, regardless of their actual dividend yield.
Mhm.
Whereas you're kind of flipping that over its head now in terms of a high dividend yield strategy, you're looking for companies that are really high yielders in terms of, relative to their peer group or relative to their initial universe in terms of what SPDV is doing. So that's like the main difference between those strategies. So SPDV, we would anticipate to have like a higher dividend yield relative to BDIV over the long term. BDIV's more of like that growthier type of play, whereas SPDV is like that consistent high dividend payer in terms of its overall strategy. So, just to give a little bit of a background on the strategy, as I mentioned, it was our first launch at AAM. SPDV was launched in 2017, so it's been around for close to 8 years now.
Yeah.
And we're starting off with the S&P 500. So we're starting off with a really good initial universe because the S&P 500 is obviously the most well-known stock index in the country, has its own set of criteria of its own, requiring profitability and being able to be of size. So basically, the market has also kind of given credence to the stocks that are within that index as well. Starting off with that initial universe, we're essentially enacting a high dividend yield screen and a free cash flow yield screen, and basically calculating a composite score. Once that composite score is calculated, it's choosing the top five, the highest scorers, the top five highest scorers in each GIC sector in order to construct the final portfolio. So you have 11 GIC sectors,
Mhm.
5 companies per GIC sector, 55 companies total, equally weighted portfolio. So we're really trying to spread out. Like we're really like diversification is definitely the key in terms of the final selection and in terms of the overall weighting scheme. So typically, not like upon a rebalance, not one sector is going to make up 10% of the portfolio. So you're really overweighting some of those more defensive sectors that typically are underweight in the parent index, being the S&P. So when we were seeing that, right now in terms of some of the, again, going back to like that Mag 7 sell-off that we're seeing this year, SPDV has definitely been holding up pretty well, a little differently relative to the market, because even though it's filtering from the S&P 500, its overlap to the S&P 500 has typically been anywhere from 5 to 10%. So pretty high active share, pretty
Mhm.
low overlap to its own parent index. And that has allowed the strategy to, one, be a nice equity income play in a portfolio, obviously, but also a nice deep value play as well for investors looking for something that's a little bit differentiated from a typical, growth style type of strategy. You can use SPDV as a counterbalance in order to kind of get the best of both worlds and overweight some of those more defensive sectors. So yeah, and in the current environment, from our standpoint, interest rates are obviously pretty high. They've been lowered
Mhm.
by 100 basis points since the end of 2024. And it's our view that we think, higher for longer is here to stay. Naturally, some of the macro news that we've been seeing in terms of like trade wars and the potential impact on inflation expectations could potentially result in a higher for longer interest rate environment. But should should rate cuts end up ensuing and come at a maybe a quicker rate than some might be expecting, definitely a play like SPDV could potentially be a nice fit for those looking to take on equity risk in order to increase the income potential of their equity sleeve as well. So definitely seeing a few ways in terms of how advisors are looking to use SPDV from like that counterbalance to a
Mhm.
typical growth play, but also obviously as an equity, traditional equity income play within their core U.S. equity sleeves as well.
Yeah, what I really like about this one in particular, SPDV, is the sector allocation. I think that's a really unique way of approaching it. Take the 11 sectors and pick 5 of the quality high dividend yield names on each one to give you true diversification. So to your point, you're not stuck with the biggest names taking up the majority of the portfolio. It balances out pretty well. And just for everyone's awareness right now, the top holdings are Gilead, AT&T, IBM, Verizon, and Johnson & Johnson. So obviously that can change over time, but those are very defensive, stable names that hopefully will hold up well in all market conditions. Showing the expense ratio at 0.29, and the current yield is around 3.8. So definitely a lot higher than the previous one we talked about to give you that current income right now.
Yep. Yeah, and then and also in terms of like the overall portfolio, no Magnificent Seven exposure. Those definitely aren't high dividend yielders, at least at
Yeah.
this point in time. So yeah, definitely like we've again kind of goes back to like just the overall diversification, strategy that's taken place within the index that it's tracking.
Yeah, and you're still going to get, those 5 names in the information technology sector
Yep.
and the communication services sector, where we're just looking for the higher yielding ones in those sectors. So you still get exposure to each one, but you don't have the Mag 7, as you said. Okay.
Yep.